Well, greetings to all my investment clients. My name is Walter Mazars, your wealth manager, CPA tax advisor. I'm recording this on Saturday, day before Easter. So what you see on the screen in the video is a traditional food basket. That Polish tradition is we take our food basket on Saturday to get the food blessed so we can share the blessed food on Easter Sunday with family and relatives and friends. So again, wishing all my clients a blessed Easter Sunday. Hopefully you will be celebrating with family, friends, and enjoying Easter breakfast, maybe in the Polish tradition as we do in our house. So let's get into, first I need to show you disclosure. Again, apologies that I did not record stock market recap last week because of tax season. I just ran out of time to record the video. But again, just want to emphasize this video is exclusively for my investment clients. Anyone else watching this video, please do not take this as investment advice or solicitation to buy or sell any investments or securities. If you want more information about myself and Trinity Wealth Solutions, you can go to brokercheckfinra.org to get more details about my background and also Trinity Wealth Solutions. So let's get into pretty much the stock market. And I'm looking at 1 month. And again, reminder, we're comparing QQQ, which is an ETF representing technology, SPY representing the broad market S&P 500, TLT long duration bonds, and gold for the last month. And as you can see, the stock market is really that it has a downward trend right now. Gold did extremely well. We were in gold a while back, but we pulled out because gold also is peaking, topping, and if there is a stock market correction, unfortunately, gold may also correct. So if we look at the 1 year performance of the stock market and bonds and gold, you can see there's really no clear direction of which direction the market wants to go. Right now, over the last since really January, the market has been kind of treading water, and it pulled back. There was a huge pullback on April 7th, then kind of recovered, bounced. So we are sitting on the sidelines, sitting in U.S. Treasury bills, paying about 4.3%. One of my clients asked me to go into more specifics. What are we thinking, short-term, long-term? And quite honestly, this is an honest answer. I really can't tell you which direction we're going to go. We're just sitting. The way I explain it to my clients is kind of we're on the shore watching a storm from the sidelines. And right now it is a storm in the stock market. Any news drives the market either up or down. And the best thing we can do is get out of the way right now. Be on the sidelines. And that's really what we're doing because there is no clear direction where the market wants to go. Yes, some clients say, well, we should have been in gold. Hindsight, very easy to say, yes, we should have been. But if you see, we were in gold up here, and then we had a signal to pull out because guess what? Gold was up 16, and then it gave up about 10%. And again, we didn't know. And then it was kind of treading water here. And then now it took off because tons of uncertainty. There was a pullback. Now it's back up. But again, this is topping. Gold is topping right now. And the last thing we want to do is get emotional and say, well, we should have been in gold, and why don't we, go into gold, kind of FOMO, fear of missing out. Well, you don't want to buy at the top, because if the market continues to go down, gold will follow. And to prove my point, let's take a look at 5-year history of what gold did. If we look at 2021, remember this was kind of COVID. Markets were kind of heading up. Gold wasn't doing anything. But then as markets started to trend down, guess what happened to gold? It also went down. So kind of at the peak, gold was about 15%, but then it gave it all back and then some, lost about 18%. So again, we don't want to get emotional, get into things that are overpriced. There will come a time where we will get back into gold, but we're waiting for reset. So to answer my client's question, can I be more specific? What we're thinking, really, what we're thinking is at some point, if we look at long duration bonds, you can see it's been beat up right here. Over the last 5 years, long duration bonds are down about 48%. So the storm is not still over in long duration bonds. This is still not a time to get into long duration bonds. And let me kind of show you why we're still sitting on the sidelines. Here's a 20-year bond for 1 year. Interest rates in 2024, April, were kind of started to head down. And this is where we thought maybe it's time to get into long duration bonds. But then we got out because it was a false signal. So interest rates started to go back up and down. Now they're back up January 1st, then they went down, and they're back up. So no clear direction. What we say in the industry, clear momentum that interest rates are going to be heading down. If we look 5-year interest rates, 20-year bond, you can see interest rates in 2020 were extremely low. And then they started to go back up as inflation. The Federal Reserve was trying to fight inflation, so they were raising interest rates. And now it's kind of treading water. There's no clear trend right now if we see since 2023. It's just kind of bouncing all over. So until we see a clear trend that interest rates are going to come down, that's where we're going to get into long duration bonds. And just a quick reminder to my clients, in 2020, the market lost about 40%, and we got into long duration bonds, and our clients actually for that year were about 20 to 25%, where the market was down 40%. So that's what we're waiting for. So hopefully that answers the question to one of my clients. Again, we're just waiting. The word right now is patience. Please be patient. This is going to pay off, and you'll understand why we're doing what we're doing. So if we go back to the market, and if we look at 1 year, we pretty much got out of the market. It was, I believe, February around 21st. So we missed the majority of the downside. And my clients are grateful and thankful that they're not down, 10, 15%. So we're just waiting right now, waiting and seeing which direction the market is going to go. We get technical research from our research company, and right now they're just telling us, just be patient, let the market work out, weather the storm. And the best place to be right now is on the shore. and watch that storm out in the sea. And that's really what's happening with the stock market. It's news driven. One of the things, this is my personal opinion, the Trump tariffs, again, what he's trying to do is level the playing field with other nations. Now, as negotiations will complete, and the latest information we got is it's pretty close to some agreements with some of the European countries, Japan, Australia, Canada. If those tariff agreements come to fruition, the market is going to pop. In other words, there may be even a significant pop in the stock market. But the question is that going to be a sustainable upward momentum for the stock market? Lots of information that's coming out. Economic news is not good. The economy is trending slowly to a recession. And there's more and more economists, Wall Street experts are saying, look, the risk of a recession has increased dramatically. What's going to happen? Again, these are probabilities, no certainties. So just be patient. Right now, we are sitting on the sidelines and waiting for that right opportunity to come, whether it's in a month or two. I really can't tell you, but I know we'll see when interest rates start to trend down and it's sustainable lowering of interest rates by the Federal Reserve. The bond market is saying long interest rates will come down. We just don't know if it's in a month, 2 months, 3 months. Why? Because the bond market is saying there is no threat of inflation and there is greater threat of a recession. That's what long interest rates are indicating, that the central banks, especially in the U.S., is going to be forced to lower interest rates to try to stimulate the economy. So, again, thank you for watching. Wishing, again, everyone happy Easter, and stay tuned to our next week's stock market recap. See you soon, and take care. Bye now.